All right, good morning. It is Monday, June the 10th, 2024. We hope you had a nice weekend. I've got some thunderstorms behind my window here in Charleston this Monday morning, which we needed the rain. It's summer's definitely here. My grass is getting a little bit like crunchy, so definitely we'll welcome the rain here this morning. I wanted to start with what I thought was a really nice article I came across last week. Is the 4% rule too safe? Written by David Blanchett in Think Advisor magazine. Okay, so 4% rule, and we've discussed this quite a bit in previous videos and webinars that we've hosted, but it's easy to calculate, kind of back of a napkin math, right? So if you have $1 million portfolio, take 4%, $40,000. That's your spending rate the rest of your life in retirement. Okay. The author argues that might be a little too conservative for a number of reasons. Okay, so just to back up, really there's two ways you can mess up in retirement. Number one being you run out of money. Okay, that's not an option. But number two, dying with regret. Okay, and kind of what I see. The problem is, like, if we focus too much on number one, running out of money, we almost certainly guarantee number two. Okay, and I think it's a mistake a lot of retirees make. Okay, and David Blanchett also touches on this a bit in the article. Okay, so in terms of the 4% rule, is it too safe? He argues number one, yes, because retirees often overlook other income sources. Okay, so what does he mean by that? If you have Social Security, if you have a pension, maybe you have some kind of guaranteed other income source, maybe it's an old annuity that you purchased many years ago. Particularly if you have those other income sources down the pipeline, okay, like, and maybe you retire before some of those income sources begin, you almost certainly can withdraw a larger percentage than 4%, but particularly early in retirement, right? Because then, maybe when the pension starts, when Social Security starts, then you can reduce portfolio spending later in retirement. Okay, so that's point one. Point two, and I think this is probably the most important one, the 4% rule is going to, really it fails to account for income flexibility throughout retirement, right? Because there are different phases of retirement. And I've seen this a number of times, but I like it. You have your so-called go-go years, and then slow go, and then no-go. Okay, so kind of break up retirement into go-go years. Early on, you're healthy, you can go. Slow go, maybe more into the late 70s, 80s, and then, once you're in your 90s, it's, if you make it to 90, for most people that it's tough to get around, right? So the problem with the 4% rule, again, it's static, right? So you have the $1 million portfolio, 4% withdrawal rate, 40,000, and that's just a static amount throughout retirement. And so it really fails to account for these different phases of life. And it doesn't reflect how people typically want to live, their retirement, right? So, and that's why, anyone that works with us that's watching this video, you know that when we do reviews, we encourage people, particularly early in retirement, when they have their health, go on the trips, go see the kids, grandkids, like, go spend more early on, because at some point you might not be able to, right? So if the resources are there, go during those go years, right? And so another reason why maybe the 4% rule might not be ideal. Point three that the author makes is the 4% rule inadequately evaluates outcomes. Okay, so the 4% rule, it's based on a data set back from the 1900s, and it's based on a worst case scenario. Okay, and my real gripe with it is what's called the Monte Carlo analysis, right? So it's based on a kind of like a probability of success. And I know we've touched on this also in prior webinars and things, but the problem with Monte Carlo, in my eyes, right, it gives you a number, right? This probability of success. So, maybe you type in the income sources you have, and it's going to run thousands of simulations, and it says 78% success probability, right? And so for a lot of retirees, it's like 78%. That doesn't sound very good. That's growing up, that was a C plus in school. I want to do better than that. And so the problem is, even though that's 78% of success, I think it scares a lot of people into, hey, we need to reduce withdrawal rates to preserve. We don't want to run out of money, right? And so again, just some shortcomings of the 4% rule. I enjoyed the article by David Blanchett. It really kind of goes hand in hand with what we believe in the office here, because at the end of the day, it's all about finding a safe withdrawal rate that really balances safety and practicality, and helps you live the best retirement you can, and to be a blessing to those around you. So I enjoyed the article. Just looking at market last week, okay, so definitely the biggest economic headline came Friday when we received the jobs report for May. Much stronger than expected, 272,000 new jobs, almost certainly pushing rate cuts out further. Equities closed a little bit higher, actually, which was a little bit of a surprise. Just with the expectation that rates stay higher for longer. Personally, I was a little bit surprised to see the equity market that is, hold up as well as it did. So big number this week will be Wednesday's CPI, Consumer Price Index. So we'll get the latest read on inflation for the month of May. That'll be a fun one. But besides that, we hope everyone has a great week. Questions, comments, concerns, please reach out to our team. And we look forward to seeing you soon. Thanks.